Hello, everybody. So I'm doing this recording called Lecture 2A because the second part of this module or the second lesson is it's quite heavy in terms of the knowledge, and we'll have to go through a case study. At the same time, there is a requirement for some prior knowledge, probably what you learned in year one on financial management. So I'm taking this opportunity to go through the case study over this recording, as well as a short recap of what you should know from your year one module so that you can understand the modern portfolio theory, which we'll be going through in detail in lecture 2B, which is the physical one that we will have this Friday. All right. So we'll start with the case study, and hope all of you have read the case study before watching this recording. So it's the Inger family case study. If you can see here, I've already done some highlighting. Don't worry about it. We'll go through it step by step. All right? Sure. We'll first go to the case study. And basically, the case study asks you to go through these 5 steps, right? So first of all, do the cash flow, identify the cash in and out, know whether it's recurring, taxability. They also ask you about the computation of the 5 years cash flow projection. At the same time, also the investable asset amount. I think we tried this the last time. Sorry, just erase this. I believe we calculated a few, I think once in the last lesson, how to calculate, how to do the investable asset amount, the risk and return objective, and the investment constraint. So for part 4 and 5, just want to quickly show you the slides in the last lecture that we went through. So when we talk about the risk objective and risk tolerance, right? Remember, we have to mention all these components here that we talked about in the last lecture, as well as for the investment constraints, we will have to tackle every single 5 components that we talked about here. All right. So when you strategy, when you do the case study, is to first of all, know what you have to look out for, and after that, as you go along, try to annotate the case study on the side, because sometimes the case study, like in this case, can be very long. It's 2 pages, and there are so many details, right? So you want to annotate, so to say, okay, is this under liquidity? Is this maybe a unique circumstances that I need to consider? And from there, then you can put all the information together, and finally, draft your answer. All right. Okay, so if you jump back to the slide deck that I have provided to you, you will notice that there are some solutions to the case study as well. But I want you to take note that the solutions, okay, the calculations are there, so at least you don't have to worry too much about the calculations, and I'll go through them. But in terms of IPS component, like for example, the risk objective, risk tolerance, liquidity, etc., they might not be entirely comprehensive, right? So as we go through the case, I'll point them out to you. What is this considered a risk objective? Is unique circumstances, and that would be even more comprehensive than the answer that's written on the slides. All right, so that's something to take note of. In your let's say if this comes out in test or exam, your answer, you should be very detailed in terms of what is being explained, or what's required for each component, as I'll explain as we go along in the case study. All right. So just want to highlight again, the caveat is that whatever you see in the slides might not be comprehensive enough, right? So what we discuss is more important. Okay. All right, so let's just jump into the case study here. And at the same time, we can, annotate and discuss some pointers that we notice in the case study. Okay, so let's go line by line first. All right, so first of all, you are Victoria. All right, you work in an investment bank and you manage a portfolio of, let's say, private clients, right? And one of the family is the Inger family. And first of all, they say that they reside in a politically stable country whose currency trades at a fixed rate of 1 to 1 to euro. So most likely a European country, right? The inflation, it's about 3% per annum, and the annual growth, and there's a nominal annual growth of 6%. All right, so this will be important for our first part of the question, right? The first part asking about, let's just quickly jump back to the requirements about the cash flow, right? Cash in and outflow, because you need to calculate the tax amount, the inflation amount, and of course the 5-year projection will be important as well. Okay, so this is something that you want to highlight. All right, so they say that the country which the Inger family resides maintain a flat tax rate of 25% for all personal income, and the net capital tax of 15%. All right, so this one. Okay, for this point, I want to highlight to you that this might be under the IPS component of tax. Remember tax? So you notice something, that the income tax is much higher than the net capital gain tax, right? Meaning, but if you are the financial or portfolio manager, you might want to try to channel more of the Inger family income towards the capital gain area rather than income tax, because you basically you can actually help optimize Inger's family tax. All right, so remember we talked about tax optimization in the last lecture, so this is something important to take note of. So this is on tax. Sorry, it's tax here. Okay. Of course, the rates are important as well, because we need to know later when you calculate the cash in and outflow, what are the rates, right? So all personal income tax will be 5%, right? Okay, at the same time, we notice that there is an inheritance or gift tax of 50%. This is important. So anything that Inger family is going to give or inherit will be taxed at 50%, which is very high, right? So perhaps when we think about such high gift and inheritance tax, we might think about, maybe, you know what, I should do a trust structure, right? A trust structure usually is incorporated, let's say, remember we talk about Cayman Islands, British Virgin Islands, and those are low tax jurisdiction countries. At the same time, we might actually have to circumvent some family inheritance tax and gift tax. All right, so these are the pointers that you should write in your answer. Okay, moving on. The country maintains a national pension plan, all right? The long-term viability is called into question. Okay, there's a bit of issue with the plan, right? Because of an unfavorable demographic trend and retirement age of the recipient. Okay. There's a ongoing public debate, and the outcome is to create a self-contributory tax advantage account. Okay, remember we talked about this tax advantage account. And so the taxpayer will pay, may annually contribute, let's say 5K of after-tax income, remember after tax, to this retirement account, which they control, and the investment returns are exempt from taxation. So this is a tax benefit. At the same time, participants may begin to make tax-free withdrawal at age of 62. Okay, so this is a very typical, almost like our CPF system, right? But these are restricted accounts. So basically, when you contribute 5K after tax income to this account, your 5K is basically locked in. So we need to think about a bit of the liquidity concern, right? Let's say, as we progress reading the case, we notice that, you know, the Inger family maybe requires more liquidity, and so putting money into this account might not be so viable, even though it is tax-free and it's pretty good. But remember, they have to contribute 5K after tax income, so it's not entirely tax-free. Their income would still have to be taxed at 25% first. Whatever remains goes into this account, right? So something to think about, this special account that they have. Okay. Now moving on, you have been asked to manage the Inger's family account, and you have arranged a meeting, okay, with Peter and Hilda, okay, and who has been married for 37 years, and they have 2 kids, okay. And they mentioned that the kids are 25 and 30. So the age matters, right? Because so the kids are not super young. They don't really, I guess the family, Peter and Hilda don't really have to so-called pay too much for the kids. Maybe they might want to do something, but at least they're already adults. So something to take note of. So okay. So the 3 of them or the 4 of them have been invited, but Krista resides considerably far away from parents. So basically, Krista is overseas, right? So Hans, which is the son, I guess, the son is in the country that they all reside in, but Krista is somewhere else. All right, let me take note of too. Okay, let's move on. The next paragraph, nothing too much. Now, let's look at this. So Peter is 59, successful entrepreneur who found a boat manufacturing business. All right. So immediately when you see about entrepreneur, think about, remember the cognitive biases or some unique circumstances that Peter might have, right? Given that he's an entrepreneur, he might be risk-taking, right? But he might not be willing to give control, entire control to you, because at the end of the day, he feel that he might not be, he might trust you, right? Because he's an entrepreneur, self-made, you know, he might have a high risk willingness, ability. We have yet to see, but willingness he might be high, right? Because he's an entrepreneur, but at the same time, he might be hesitant to actually like give you control of his entire family's wealth. All right, so this is something that you need to mention in your answer as well. Okay, then he has worked compulsively to build a business. All right, so compulsively shows, you know, he could be micromanaging. You know, he's really invested in this business, right? And the boats are sold worldwide, fine. Peter also been slow to adopt succession planning. Okay, so you can immediately see that you need to convince Peter quite a bit, because you know he always believed, that's what I say, he always believed that he's the best person to run. This immediately shows a bias already, right? That we talk about, that I mentioned earlier about entrepreneurs. So okay, although in the past he resisted various purchase of the company, he's now considering succession plan and retirement. He's eager to monetize his stake in Ingham Marine and believe that he'll be able to sell the company in 1 year. All right, so he believes he can sell in 1 year here. He has he's been evaluating 3 bids, and they are 61 million. Okay, equity is 0 cost basis for purpose of taxation, so there's nothing, no tax on the capital gain, and the company stock pays no dividends. All right, so this basically gives you the background of Peter. We can tell that he wants to retire, he wants to monetize his stake in the company, but at the same time we see that he wants control as well. So these are the unique circumstances of managing the funds for Peter. Okay, so something to consider when you draft your answer. Okay, next, let's look at what their needs. So Peter and Hilda current needs are being met by Peter's salary, which is around 500K, and Peter wants to maintain this standard of living. All right, so when we talk about standard of living, most of the time is something that is non-negotiable. Meaning what? If you know that let's say this is, I think it's every year, you will definitely spend 500K, right? As a portfolio manager, that is the required return that you need to meet, right? Remember, we talk about desired and required return. This is a required return, 500K, that you have to meet so that they can live comfortably, right? Because remember, you're managing their funds. The very least you can do is make them feel comfortable, right, with their lifestyle. So this is a required return. Of course, there might be desired returns, which you can elaborate more as you read the case. All right. Okay, so let's see. There's inflation of 3%, fine. Peter expects to receive an annual payment of this from Inga Mary's pension account. So he's going to receive a steady stream of 100K. But of course, 100K is not enough to meet his daily standard of living of 500K. That's something to take note of. Now, this only begins in 5 years. So please take note that it doesn't begin immediately. Now, beginning from age of 62, which is that means 3 years from now, right, he plans to take a fixed distribution of approximately 5,000 tax exempt from his account. So basically, he already put in this so-called blocked account, which has currently 50K, right? He will take 5K only, right? And that's per year. Okay. All right, now we know a bit more about Peter, and they say that he's a perfectionist, he likes to maintain control. Not surprising to us, we already talk about the perception of entrepreneur. He seems to intend to preserve his wealth, okay, wealth preservation. He has consistently been adverse to risk and leverage and change both in his company and personal life. Okay. So we immediately know that he might be very conservative. He might have some loss aversion, right? He's adverse or he feels the pain of loss more than the benefit of gain. So you want something that's more conservative for him if you are recommending, let's say, a type of investment, right? So you want to do more bonds than more equity, let's say. Okay. Now, so Inga Marie has been following this policy with low debt and slow growth, focusing on stable income. So it basically reflects Peter's personality, right? Okay. Now, moving on. Okay, like many of his countrymen, Peter holds a portion of liquid assets in gold bullion. He believed that the gold provides a viable hedge against catastrophe, economic surprises. He plans to maintain this current holding of 500K for the foreseeable future. So basically, this gold, right, you are not allowed to sell. It's not like a trading commodity, right? So he wants to maintain the holdings in this for the long term. Okay. Remember when we talk about gold, we say that it is a safe haven investment. We say that it helps to hedge against inflation. So yeah, it's pretty good, right? But of course, whether this 500K is substantial, we need to calculate the total investment portfolio that he has. Okay, so he also has 1 million invested in fixed income securities. These are your bonds. And Peter and his several friends lost money equity investment scheme previously. So now we want to take note that he might be very adverse to equity. So it's something that you do not want to recommend to him, all right? If you are the when you write your IPS, okay? Since then, he has been biased against putting his money on stock market. So let's say if you go and write your IPS, right, and you say you want to allocate money to equity, you probably get marks taken away from you because equity is not something that you should recommend Peter. Okay. Now he had a bias against putting money in the stock market, although he currently holds diversified equity stake. Okay, so a diversified equity security could be like the S&P 500, right? So he basically is more of a follower in the market. He doesn't want to earn like super high returns. He just want to get market returns, right? Because that's why he do diversify. And of course, the stake is quite small, 750K compared to his fixed income portfolio of 1 million. All right. So they mentioned that Peter is also, he feels comfortable with investing, so he's fine investing in real estate. And mentioned that he's always been successful in investing in real estate projects. Other than that, 1.5 or 1.2 million. Other than this 1.2 million home that he jointly owned with Hilda, and he's actively investigating the real estate for his second home. So basically now we have his valuation of his house at 1.2 million. Remember, the idea of real estate is that yes, people might put it in it might be considered investment, but at the same time, many portfolio managers remove the home from the investment portfolio because it's so illiquid, right? Remember we talk about how illiquid property is. But in this case, he's comfortable to invest in real estate or treat the real estate as an investment, right? As mentioned in the case. Of course, he's looking for a second home for investment purpose. Okay, so he hopes for this home to be featured in the magazine. Anticipate that it will cost 7 million to build a home. Okay, so you have a cash outflow. And remember, this cash outflow is a one-off outflow. So we need to consider whether he has enough money to even pay for this 7 million that year. Okay. Now, Peter and Hilda agreed on a normal liquidity reserve equals to 2 years of Peter's salary. So 2 years is 1 million, right? He currently has 1 million cash and cash equivalent. So basically, the couple wants to have a reserve, to maintain a reserve. And this reserve will have to be taken into account because they need to have cash or a cash equivalent of 1 million all times. All right. Okay. Now, Peter wants to know his grandson better. And since birth, Peter has been estranged from his daughter. Remember, his daughter is Krista, and wants to restore the relationship. He will provide financial support for health and education related expense. His plans to begin a gifting program, okay, next year, and the gift will be 15K per year, increase with inflation. So we need to increase. We need to consider the 15K on incremental basis with inflation. So it means that it's not 15K all the way. It will increase with the 3% inflation. This will be a unique circumstances as well. He wants to get to know the grandson better. But not only that, since you want to provide financial support for health and education, we need to think of whether we should recommend a trust, right? So a trust might be pretty useful in this case here, because a trust, I mean, first of all, the grandson is probably very young now, and we want to accumulate the wealth for the grandson, and we know the specific purpose is for health and education, right? So a trust structure is perfect in kids. So you should recommend something along the lines of trust. All right. Okay, so Peter has a passion for photography. He anticipates to purchase a minority stake of 5 million. So this is another outflow that will happen as a one-off outflow to this company, which is like a photography magazine. And the purchase will reflect his desire to support the magazine high quality. Okay, fine. Because of this investment is likely to produce meaningful current return. Okay, so this investment will not grow in the future. This is important to take note. The investment will not grow in the future. He do not intend to make any further investment into this company other than the 5 million that he's planning to make. All right. Now, he wants a strong desire for family's financial security. He feels that they have accumulated enough wealth through the sales of the company that we talk about, and he does not, however, have a formal estate planning. Okay, so he does not know how he should transfer all these assets to his kids and grandchildren. That's why you are here, right? He would suggest, like, let's say, the trust structure, whether to have more capital gains rather than income, of course, to also avoid the inheritance and gift tax, right? I mean, there are so many other things that we have already talked about, but these are the some that I'd like to point out to you. Now, let's look at the last few paragraphs. So now we talk about the wife, Hilda, right? So she comes from a wealthy family. She's a beneficiary of the trust established by the family, and the trust will distribute an inflated index annual payment, all right? Inflated index annual payment of this amount. So that means this is inflation adjusted. So regardless of whatever, she'll get a real cash flow of 75K every year, okay? So we need to think about, remember, we talk about nominal and real. There's something we need to think about now. And at her death, the payment will stop. The trust will be donated to the local charity. So something to take note is that So yeah, you have this trust, but this trust is not going to pass to their grandkids or to their kids. Okay, so it will be transferred to a charity. Now, Hilda has intentionally removed herself from the family business, and and she has been a major factor, however, in Peter's decision to retire and have a second home closer to her daughter and grandson. So the second home that they're going to build or to purchase will be closer to the daughter, basically to get closer to the daughter, right? Because the daughter is a bit estranged. In light of the major change, Hilda wants to be more knowledgeable about actively managing the family's wealth. So we know that Hilda does not have knowledge of financial planning, maybe quite similar to Peter, that's why they engage you, but she's willing to learn. Okay, she has a strong interest in interior design, and for 2 years she founded a small sole proprietor. Okay, good. And she's eager to apply her talents and build the new home. So basically, she's going to use her skills to build or interior design skills to design the new home. Okay. Now, it's important to take note that the current company employs is operating at a break even, meaning that they are not actually earning anything, which is fine. At least it's not a loss. But in case it's a loss, Hilda must make sure that she has enough cash to build out the company, right? Some more, remember, it's a sole proprietorship, means that in case the company goes into bankruptcy, the court can actually take possession of your personal assets, right? Because remember, this is not a private company, it's not a LLP. So this is something that you should take account of. Of course, this tap on your knowledge in year one when you learn what difference between sole proprietor and LLP or even private company, right? So something that she needs to be careful. Yes, you might be breaking even now, but what if in the future your company makes a loss? Then your personal assets will become liable. All right. Okay, so both Hans and Krista are married. Okay, once you see this, right, we know that, oh, you know what, actually Krista is unmarried but has a kid, means that she's living alone, and maybe she needs the help from her parents as well. So we need to help Krista. All right. Now, Hans is currently working as a senior vice president in Inga Marine, specialized in boat. Peter tried to involve Krista in the family business, but she's resistant. Instead, she achieved a moderate recognition and financial success as an artist. So now we know that Jugen is 5 years old, which she chose to raise alone. Okay. So all these are information. A lot of information now. We have already dissected the case. So this is how I'll recommend to typically tackle a case. So read what's the question requiring to do, and then dissect the case as you go along, so you don't miss out. And then all those pointers that I mentioned, you should be jotting down on a sheet of paper, so that when we put them in the answer, they'll be very coherent, right? Okay, so very good. We have read the case. Now, let's tackle the cash in and outflow first. And remember, we need to pay attention to the timing, one-off nature. We remember we talked about some of them being one-off. For example, buying a house or investing in the magazine. I think it's 5 million in the magazine. So those are one-off, right? All right. Let's have a look at the calculation. So like I mentioned, the calculations, the details are all here. So do not worry, you have all the answers. This is a case example for you. Okay, so we have to put in all the information. Remember, we know Peter's salary. Yes, it's recurring, but until a certain age, right? Until 59, where he plans to retire. He plans to retire or sell the business in 1 year. Remember the taxability of it. Of course, we have Hilda trust payout, and then it is, yes, remember its income is still taxable, but at the same time, it is inflation adjusted, right? We talked about that already. Now, Peter's pension plan, it is going to pay out from this pension plan is from Inga Marine, right? The company. So after, let me just quickly flip back when he's going to get his pension plan money. Let's see. beginning 5 years from now. Let me just quickly highlight this. So a pension plan, it will begin 5 years from now. All right, so we will have this pension plan amount at 64, so it's 59 plus 5, right? So at age 64, it will be a constant, and of course, it's still taxable, right? We mentioned everything is taxable. Okay. Now, Peter will also have a withdrawal from this blocked account of 5,000, and it starts from 62 years old. It's non-taxable, remember, and it's a constant amount. Now, sales of the company, remember he is making sales of Ingham Marine. This is a big chunk, and they say it's taxable, right, at 15%. And this will occur 1 year from today. He's 59, so he'll occur in age 60, and he'll have a lump sum of this. Okay. Now, some cash outflow, remember, they do have a living expense, and this living expense will increase with inflation of 3%. They also want to support their grandchild of 15K. And remember, this is something that we should recommend to put in a trust system, because he's too young, he's 5 years old, and you want to accumulate the wealth, and you only want it for health and education, right? And now, remember, because you're putting this money or giving this money, you will have a gift tax of 50%. So now, at the moment, they're assuming that Peter's giving the money, right? But if you recommend a trust system later, that will actually help circumvent this gift tax. So you need to think about that, okay? Next, they want a second home, which will cost 7 million. This is quite a bit. And then they want to invest in magazine, which is 5 million. All right. So these are all the cash in and outflows in the case. Now, after doing that, we plug in the values of the in and outflow in a cash flow projection. So I hope this is not new to you, like you have done discounted cash flow, DCM, in your previous module, given that year 3, year 4. So hopefully this is not new. So basically you put in all your inflows, all right, your outflows, which will be inflows first, your sales of the company. This is a lump sum amount. Remember that the trust is a risk adjusted, as an inflation adjusted, so these will have to keep on increasing. And the Peter's withdrawal of the blocked account or the RSA can only happen at year 3, year 4, year 5, and also the pensions only happen at year 5. All right. So then you get your total inflow. Now we need to calculate total outflow as well. First of all, we need to take into account the income tax. Remember, in the past, the other slide, we say what is being taxed at what rate, and so we need to calculate what's the income tax. What's the capital gain tax at 50%? This is mainly due to the sales of the company, of course, purchase a second home, the investment in the magazine, and how we're going to support the grandson, right? Remember this, we are support the grandson on a risk adjusted, inflation adjusted basis. So it's 15K, yes, for the first year, but it will keep on increasing like this. Huh? Of course, we know that there will be a tax. So basically, at the end of the day, Peter will have to put, let's say for the first year, 15K plus 7.5K in order for them to get 15K support in this structure here. So they have to put more than 15K. If you notice here, there will be a tax on them, right? At the same time, they have their living expenses of 500K, which will increase with inflation. And yeah, so you have your total outflow, any net withdrawal. So this is the net, right? So net, that means inflow, inflow minus outflow. And so you notice that currently there'll be outflow, but then in year 1, there'll be a big inflow, which is supposed to support them for the rest of the year. Okay. So this is the 5-year cash flow projection. Now, the next part, the third part, would be to talk about the investable asset and the required return. I think we have done this portion before, but similarly, we know that there will be a cash inflow, a large sum of this amount, which we saw in the previous slide. Okay. Now we know that they have a stock. Remember, he's adverse to equity, but he do have a diversified stock portfolio of 750K. Okay, we have fixed income 1 million, cash and cash equivalent. Remember, this is the liquidity float that he wants to keep. All right. He has a RSA account. So all these are your investable stuff, right? Now, in terms of real estate, these are more illiquid. He has the first home and he's going to a second home. And remember, his goal is supposed to be maintained for the foreseeable future of 500K. So all these, and notice gold is such a small portion. At the same time, can you see that real estate is such a big portion? So this is a concern because we know that real estate is very illiquid, right? So it's something that we need to think about. And most of his income comes from the first year sales of the company, which is in cash, which is good. All right. So after doing this, we can calculate the required return. How do we get this? We know what is investable. Only all these are investable. That's why we put this here. Okay. Remember, real estate is illiquid, so we typically exclude it. At the same time, the goal is for foreseeable future, so we exclude it. So we only think about what can be invested, which is the around 42 million. And distribution from year 2 onwards. Let's quickly go back and have a look. Distribution from year 2 onwards is let me just quickly highlight this for you. It's this one. All right. So that's where you plug it in, and then you get the returns. And remember, when we talked about adjusting, this is a nominal. So you should use the Fisher equation to adjust this. In this case, they just add 3%. This is not theoretically correct. So if you add 3% inflation plus this, then you get the so-called inflation adjusted return. But remember, we should use Fisher equation instead. So try to use Fisher equation because that's the right method to do it. All right, don't use this. All right, so now we are going to the IPS now. I will not go into details. You can read through this because whatever we have discussed as we go line by line in the case study is applicable for the IPS. All right. So just have a look at this. Basically, I want to repeat again that what's written in the slide is not comprehensive enough, and you should remember of what we discussed as we go line by line. So those are the pointers which are even more comprehensive than what's written on this slide here. Okay. Okay. Remember, for risk objective, you need to mention ability and willingness. And something I want to highlight here is that we always take the lower of both, right? If the ability is high, in this case, abilities might be high, but willingness is low because remember we say that Peter is risk adverse. So tolerance in total is just maybe low or average. All right. So there's in terms of answers, something like this, there's no fixed answer. It's actually how you argue your case. All right. Of course, you need to substantiate well as well. Liquidity, we need to think about the long-term and short-term constraints. We need to think about the proportion of illiquid assets. For example, I think it's around how many percent? 16%, all right? 16% is resident. So this is something we need to be careful of because we know that buildings are very illiquid. So it's not good, all right? And of course, they need to have a liquidity reserve of 1 million. So this is something that we need to consider. So time, tax horizon. I want to highlight here in terms of tax, we talked about the capital gain tax being lower, so you want to optimize tax. We talk about the trust structure. We should mention trust. This part didn't talk about trust, so please mention it. Time horizon, of course, it's more long term. Let's talk about it as well. Now, there are more details on tax. They want to transfer this, so this you should. Oh, they did mention about trust. So yes, this establish a trust, and they might also consider establishing a trust for themselves, right? so that when the beneficiary dies, the trust will remain and distribute assets to Hans and Krista. So doing a trust structure might reduce the tax implications as well, right? Some unique circumstances, we say that they're going to sell the company, they want limited exposure to common stocks, but not only that, I think the other component is that Peter wants to get closer to the grandchild as well, right? So something that we think about. Okay, so now that's the whole IPS and the creation of various statements. This is a very long question. Now, this is the second part of the question. So they say that, you know what, part B, right? Part B, they say that, now the company is facing some difficulties. And because of that, the company is going to bankrupt, the stock is worthless, the pension is lost. Wow, very big issues now. Assess the impact on Peter's and Hilda's return requirement and portfolio constraints. Okay, so first of all, we know that a big proportion, I think 77% of their income or their investable assets will come from the sales of Inga Marine, right? Now, because the company is bankrupt, this large portion is gone, meaning that they should not, or they would have an issue maintaining their current lifestyle. Okay, so Peter and Hilda will have difficulty. First of all, they must cancel the second home investment, remove the gifting program. They might want to sell their current house, of course, reduce their spending of $500,000, and also postpone their retirement, maybe return to the workforce, because he needs to I guess earn some money, right? So yeah. Okay. So there'll be some changes in terms of the IPS as well. So we look at the liquidity, time horizon, tax. So we can talk about, let's say, yeah, all these factors, right? First of all, he needs so spending commitments might be difficult. He might need to change it, reduce his spending, or change the liquidity needs. Okay. So tax also, in fact, the tax burden would be reduced, right? But something to take note of, remember we talked about loss harvesting. So because the company is making a loss, we might be able to harvest this loss and so reduce the overall taxable income in the future. All right, so that's all for the first part on the case study. Now we'll proceed to the second part, and basically the second part, if you're familiar with it, you can skip it. Basically, it's a recap of what you've learned in year one on financial management, which will be important for the modern portfolio theory that we'll be going through, right? All right, so that's a short break. Welcome back. Now, let's talk about the financial management, right? The main thing I'll be covering here is, first of all, focus on a recap of what's expected return, how do we calculate diversification, how do we calculate covariance, correlation. So I hope for those that remember these concepts, you could actually skip this part of the last part of the short lecture. Okay, but for those who have totally forgotten, don't worry, we'll go through it step by step again. Okay, so first of all, let's look at what's expected. So whenever we see this idea of expected, we need to consider probability of the outcome. So we know what's a return, right? Return of an asset is how much you get from the asset, and the returns are usually measured in percentage, yeah, percentage. So when we think about expected return, we need to consider the probability of this return occurring. So that's why you have this. What is this 1 and 2? It shows that what do you have to do first? First, you have to calculate the state, the expected return. Then you do a summation of the various probabilities or the various state of events happening. All right. There is example in the next page. So we see that there are 3 states: recession, neutral, and boom. And now we know the returns, we know the probability of them happening, and so we can calculate the expected return by simply, just multiplying, and then you add it up together. All right, so this is the example. This is what has been done here. So this expected return is here, and you just simply multiply. Okay, now, so that's about returns. When we want to measure risk is measured using standard deviation, okay? But in order to get the standard deviation, we need to calculate what is the variance. And so this formula is the variance formula, right? It's a square. So standard deviation is the square root of the variance. I want to highlight here that, remember, risk or total risk is always measured in standard deviation, not variance. Why? Because variance has a square. Meaning what? If let's say you're measuring risk, right, and returns are in percentage, your variance will give you percentage square. And how do you compare percentage square with a percentage or other kind of units, right? What does percentage square means? You don't really know, right? Which is why we always measure risk as the square root of this, which is the standard deviation. Okay. So how do you measure standard deviation? Basically is how much the actual returns is deviating from the expected returns, which is why we have here the actual returns. How much is it deviating from the expected returns here? And of course, we need to square it in case we want to remove any negative. Once you square it, it becomes positive, and we need to take into account the probability of that happening. And finally, in step 3, we need to take into account the summation of everything. All right. So this is a classic example of how you calculate the variance and standard deviation. What we are interested in, of course, is more of the standard deviation here. Okay. So just follow the steps here. We take the expected return. We find the deviation from the expectation. Remember how you calculate the expected return? We need to calculate the 3 states, right? So this time this, this time this, this time this, then we sum up to get this one. And then after that, we take the deviation, which is the actual, right? Negative 20 minus this, then you square it, right? That's how you do the standard deviation. Okay, I repeat again, how do you calculate this standard deviation here? We take the actual, which is, let's say this is, let's say I'm doing neutral. Neutral is 15% minus this 11.25, and then you square it. Okay. After that, last but not least, you multiply by the probability, and then you do a summation. Now, so that is the basic, like one kind of one security calculation. But remember, in this course, we're talking about portfolio management, right? So we want to look at a collection of assets, which is portfolio. And this, by having a collection of assets, there is some diversification kind of rewards, and therefore the risk will actually be reduced. So remember, all these are just recap. So when we think about portfolio, now we need to think about the weight of the portfolio. So instead for expected returns, instead of just doing part 1 and part 3, 1 and 3 here, that being here, we need to consider the weight as well. So the weight of each item will affect the expected return. Okay, we have an example in a bit. But I want to highlight that for the portfolio standard deviation, it is not, this is very important, it's not the weighted average of the standard deviations of each component. Why? That is because of this thing called correlation, CRR, or covariance, right? So if it is simply just the weighted average, then there is no benefit of diversification anymore. But there is benefit of diversification, which is due to the covariance and correlation. Okay, so I like to use this example, which is a classic example of how you calculate, first of all, the portfolio mean and standard deviation. And there are two methods. Okay, I'll first go through the first method, but personally, I'll recommend you to do the second method. All right, I will go through both methods. Okay, so now what do we have here? We have two stocks, BB and SM. Okay, we have three portfolios, ABC, and ABC portfolio has a different percentage of each of the stock. Now we're asked to calculate what is the portfolio's mean and standard deviation. Okay, so we'll go with method 1. Like, so method 1 is my less preferred method. I'll just go through it. So first of all, let's see. What we can do is we calculate immediately what is the portfolio mean returns, right? And how do we do this? So those in red are what the calculations I've provided. So you need to calculate every single one. You can do it in Excel, it's very fast. So for example, in year 2016, let me just flip back. We know that for portfolio A, we have 25 of BB and 75% of SM. So we simply just do 25 times what is the return for BB. Let's see the word. Return for BB for 2016 is negative 6.29. All right, so we just multiply them together, and then we know for SM is 8.23. So we multiply them together, and so this will relates to one value here. Now, basically repeat the entire calculation for every year for the next 5 years, and then you just do a arithmetic mean, or you just do a simple mean, right? You add them all up together, divide by 5, then you should get this, which is equivalent to this one here. So what I recommend you to do is to try to calculate portfolio B and C on Excel. Try to see whether you can get the answer, all right? Now, the mean is usually quite easy. The standard deviation is where it's a bit more complex. But if you use method 1, you basically do not really, you do not need to so-called calculate a correlation or covariance, right? Because what you have done in method 1 is that you're just calculating, oh, what is the portfolio return for 2016, 17, 18, 19, 20. And what do? You just use the Excel formula standard deviation S for sample, because we need to consider, because it's a sample, not population. And wow, beautiful. You just get immediately the answer for standard deviation of 8.77. Now, this method is perfect, right? It seems very easy. But what you miss is calculating the correlation and or covariance. Okay. Remember, both methods are correct. Okay. So that's the end of method 1. So yes, we get the portfolio standard deviation of 8.77. That's the answer. The portfolio B standard deviation of 8.44. That's the answer again. All right. Now, let's look at method 2, which is, I again mentioned, is my preferred method because we really understand how portfolio creates diversification for you. Okay, so now we have again the same thing, BB and SN. First of all, we calculate what is the mean return for BB and mean return for SM. Okay, we simply just for all the years here. So we just add them up together, divide by 5, you get the answer. Now, we know that for portfolio A, we have 25% of BB and 75% of SM, right? Which is here. So what do? We simply just plug in the values like this, and we get the mean. So mean is always easy. Now, if we use method 2, what we have to do now is that, okay, yes, we have the returns for SM and BB. Now, what we have to do is to calculate what is the standard deviation of BB, standard deviation of SM. Again, we use the standard deviation formula, which is fine, okay? But now, that's not it, right? Because we are talking about portfolio. So we need to consider the portfolio variance. And when we talk about portfolio variance, there is this formula, which is written here, weight of the first asset squared times the variance of the first asset. Variance, remember, is or standard deviation square is the same thing. All right. I already wrote the formula here. Okay. And then we have the weight of the second asset. All right, here, times the variance of the second asset or the square of standard deviation. And you must plus 2 times the weight of 1 times the weight of 2 times the covariance. So this is where the covariance suddenly appear. And it's very beautiful, right? Because remember in the last way of calculating, you don't even see the covariance. So now this is where you observe the covariance. Then the question is, how do you calculate the covariance? Luckily, you have Excel, so it's very easy. You just use this covariance formula, right? So you have all these returns here, which is given in the question. You just use the covariance formula, which gives you the joint returns for the 5 years, and voila, you get this answer. So this is the covariance. And what do? You simply just plug in the covariance formula inside here, right? So this is a repeat of the last slide, right? So this is the covariance. So you just plug it in here, and you should get the portfolio variance, and then you just calculate what is the, you square root it to get the standard deviation. All right. Now, of course, not all the time they'll give you covariance, right? So we need to know this formula here, where covariance is actually the same as correlation times this one, times the standard deviation of the first asset times the standard deviation of the second asset here. Okay, so in case you're not giving covariance, we can actually use correlation as well. All right, we can use correlation. So you should know how to do it. Okay, so how do you calculate correlation? Simply, you can use the Excel formula as well. I believe it's the formula called equals CORR, and you'll see correlation, and you should get the answer for correlation. But then you need to do one more step. You need to multiply it by the standard deviation of first asset times standard deviation of the second asset to get the covariance. Okay. All right. So this is the portfolio calculation. Now, I'd like to go further to explain more on the risk idea, right? How does diversification shape works? Okay, so we know that the total returns equals to expected and unexpected return. Now, the unexpected return can be categorized in 2 parts, systematic and unsystematic. So I hope this is not new. And I repeat again, this is something that was learned probably in year 1. Okay, now the systematic and unsystematic component, this is something that we're interested to find out more. What does systematic means? Okay, so systematic component, basically, if you do remember, is your beta risk, right? Beta risk, or what we call non-diversifiable risk, something that is intrinsic in the company and includes like inflation, interest rates, and they are basically called market risk, right? So it affects all assets. All assets have different beta risks, right? Systematic risk. Now, unsystematic risk is what's called diversifiable risk, and is something that we should eliminate if we can by creating a portfolio. And this can be unique risk based on the asset, and by diversifying, we remove the unique risk. Now, so the principle of diversification is that we want to reduce risk, right? Remember, total risk is systematic plus unsystematic, right? That's total risk. And total risk is measured in standard deviation. Total risk is standard deviation. Remember your systematic risk, your SYS, systematic is measured in beta, right? So we want to, when we use diversification, what we're doing is we are reducing the total risk. We are reducing the total risk by reducing or removing all the unsystematic component. And what's left is your systematic component only, which is your beta risk. Okay. So this removal of unsystematic risk is actually due to correlation. And correlation, there's three main ones. Is perfectly correlated means that there will be no risk reduction. This is bad. We don't want a perfectly correlated. Example is that if you buy two stocks from, let's say, the healthcare market. So like now, now it's COVID, or last 2 years was COVID. Both healthcare industry would be on the rise, right? So basically, if you buy two stocks from two different healthcare company, then there is no this perfectly correlated. Both stocks will increase, right? So it's bad. Now, because there's no diversification. Because on the flip side, if the health industry goes down, both your stocks will go down. So it's like perfectly correlated. Now, what we want is perfectly negatively correlated, where it's -1, and this will provide risk diversification. All right. Of course, anything that is less than 1 could also provide risk diversification, but if we find something that's perfectly negatively correlated, that's the best. All right. I want to remind you again that diversification only removes away unsystematic risk, and the systematic component cannot be removed. All right. And the systematic component is your beta risk. So this is an example of the various number of stocks in the portfolio, but what I'm actually interested in is the graph in the next following slides. So what they actually found out that the total risk will keep falling until about 40 stocks is included, and that is kind of the limit of reducing risk. So this is the example here. So this is the number of stocks in the portfolio. See, it keeps on decreasing, and once you hit around 40, whatever unsystematic risk that can be diversified away has been removed. So what's left is the systematic risk or the beta risk of the portfolio. All right. So in terms of risk diversification, we see that this is another way to observe the meaning of diversification. We see that the risk of a very large portfolio will converge towards the average covariance of the asset. Average covariance meaning the beta risk of the asset. How do we see this? When n goes to infinity, can you see when n goes into infinity, this becomes 0, right? When n goes to infinity here, what happens? This component here will become 0. So it's basically 1. What's left is 1 times average covariance of assets. This is how we see it. And basically, this is your beta risk. Okay, so again, a repeat, total risk is systematic plus unsystematic. And standard deviation measures the total risk. The systematic risk is measured in beta. All right, when it's fully diversified, what's left is only the systematic component. So in terms of risk, there is no reward in bearing risk that can be diversified. It's unnecessary. So if you are carrying a lot of unsystematic risk, right? There is no reward in that. You will not get higher returns. You only get higher returns if you take on systematic risk. Okay, now I'll formally mention that beta measures the systematic risk, and I hope you know what beta means. Right? Beta measures the stock volatility relative to the market. And what does this mean? So this is one of the more important slides where I highlight to you that, oh, if the beta is 1 means the average, more than 1 means the stock is more risky than the market, less than 1 is less risky. But what's important here is that these two parts here, the beta of the market is 1, right? Beta of market is 1. And of course, they are always relative to the market. So if you're comparing the market risk with the market, obviously is 1. And the beta of a risk-free, this is very important. Risk-free is 0. So this is very important. Because a lot of people are like, oh, so what's the beta of a T-bill? What's the beta of a risk-free asset? It's 0. There's no risk. Basically, there's no systematic risk. Okay. Now, that's all we have for the first part of lecture 2A. Hope you were able to watch the entire lecture 2A, and we'll continue with lecture 2B in the live format. Right. Thank you for your time.